Hi, this is Anil from Pristine. In today's session, we'll talk about equity investments. This particular topic carries a weight of 10% in the exam, so around 24 questions out of 240. So, in this particular session, we'll particularly focus on what are the leverage trades and what are the margin requirements for those leverage trades. So, what's a leverage trade? It is a trade which involves buying something with a borrowed fund. So suppose you get into a transaction which has a price of P. So this P will come from two different sources. So one would be your equity and the second part would be the amount deposited by the broker. So suppose this P is the complete bucket. So out of this complete bucket, some part would be deposited by you when you enter into a transaction. So that part is called as initial margin. So initial margin can be given as a percent of the price. So suppose the price is $100, and the initial margin is 30%. So the initial margin in dollar terms becomes $30. So this is the amount that you need to deposit with your broker whenever you enter into this trade, which is having a price of $100. Now this $30 is deposited in the broker's account, and that account is called as the margin account. So at this particular moment, you have $30 in your margin account. Now the following day, the price can increase or decrease. Suppose the price increases by $5. So the price next day becomes $105. So if there is a gain of $5 in your transaction, your margin account will increase by that amount. So the gain in the price was $5, so your margin account here will become $35. Similarly, if the price decreases by $5, it goes to $95, so there is a loss of $5, right? So the margin account will come down to $25 from $30. Now if the price keeps on going down, your percentage contribution starts going down, right? But the broker has to ensure that there is always some percentage as your equity. So they set a maintenance level of your margin account. So we call that maintenance level as the maintenance margin. So that is slightly lower than the initial margin. Suppose in our case it is 20%, so it should be $20, right? Now the idea is whenever the margin goes down than this maintenance level, you are asked by your broker to deposit the money to bring your margin account back to the maintenance margin. So whenever your account goes down from this maintenance margin, you are asked to deposit the difference of your current account and the maintenance margin. So this particular difference is called as the variation margin. So the difference of the maintenance margin and the current account is called as the variation margin. Alright, so these are the three different kinds of margins. So let me summarize. Whenever you enter into a trade with a price of P, the initial amount that you need to deposit is called as initial margin. So this initial margin is some percentage of the price. So in our case it was 30%. Now if the price goes down below a limit, suppose it was, that limit was 20%, means $20. Suppose the price goes below, initially it was 100, so it goes below say 85, it goes to 85, so your margin account will go down by 15 units from 30, so your current account will go to $15, which is below the maintenance margin. So if it is below the maintenance margin, you need to deposit some amount to bring your margin account back to the maintenance margin. So what is the difference between the maintenance margin and the current account? Is $5, is $5. So you need to deposit $5 to bring your margin account back to the maintenance level. So this $5, these extra $5 is called as the variation margin. Alright, so now using this concept we can derive the margin call price for a long position, and similarly a margin call or trigger price for a short position. So you can directly use these two formulae to calculate the trigger price for your call. So with this background in mind, let's solve a problem. So here it says that you are long in some stock with a price of $100. So price is $100, so your complete bucket is $100. So it says Mark enters into a leverage buy at a current price of $100. The required initial margin is 30% and the maintenance margin is 20%. So the initial margin that Mark has to deposit is $30, 30%, so it becomes $30, right? And the maintenance margin is 20%, which means $20. Now it's asking us to compute the margin account balance and the variation margin for this position after $15 decrease in the price on the day one. On the following day there was a decrease in 15%. So initially when he entered into a transaction, the margin account was having a value of 30% of the price, which was $30, right? Now the price fell from $100 to $85, so your margin account will also fall from $30 to $15. Now the maintenance margin was 20%, which means that you should have your margin account greater than this $20, but in the following day we went down to 15%, that is $15. So I need to deposit this much amount to bring my account back to the maintenance level or maintenance margin. So $20 minus $15 is $5. So $5 becomes my variation margin and $15 was the margin account. So C is the answer for us. So I hope you have got this concept. So whenever you get this kind of a problem, always make a bucket, start with the initial margin, find the maintenance levels, and using the price information given on the following days, calculate the decrease in the margin account, and this will help you in finding the variation margins and the margin accounts. Moreover, you can also use the previous formula directly to find the call price. So normally in the exam they can also ask you simply calculate the trigger price with this information, so you can use those formulas directly and get the answer. All right, so I hope you have understood the concept and you like this video. If you have any query regarding this video, feel free to write at anil@eneve.com. Thanks a lot. I hope you enjoyed this video and see you in the next class.